Hello everyone, thanks for checking out my video. Wall Street finally got the rate cut it was hoping for from the Federal Reserve. As a result, major US stocks rose last Friday, with the three main indexes hitting record highs and posting consecutive weekly gains. The upswing in the stock market comes as most of the Magnificent Seven stocks climbed higher, lifting the entire tech sector, with Oracle reportedly in talks with Meta on the $20 billion cloud deal, and Nvidia investing in Intel, driving the share price of Intel to a 38-year high. Meanwhile, President Trump described his call with China's Xi Jinping regarding trade and TikTok as very productive, and the two of them are planning to meet in South Korea to discuss trade, illicit drugs, and Russia-Ukraine war. With the major FOMC overhang behind us and positive news coming from multiple fronts, the question is the current rally unstoppable, and what's next for the US stock market? Let's discuss all of this in this video. Well, the US stocks got a boost last week after the Fed lowered interest rate by 25 basis points, the first reduction since December 2024. The move was widely expected by the market, but yet stocks had a volatile session on the back of the decision after Fed Chair Jerome Powell categorized the decision as a risk management cut. Powell explained that the rate reduction was a response to softer job data and emphasized that future rate decisions will depend on how the economy unfolds. That said, the Fed signaled the possibility of 2 additional cuts later this year. With the major market overhang behind us and no unexpected shocks, the market rallied, with tech stocks leading the way. Tesla ended the week up nearly 8%, while Alphabet surged around 6% and Apple jumped almost 5%. And then, towards the end of last week, US President Trump shared on his Truth Social account that his talks with China's Xi Jinping made major progress on hot issues, including trade, fentanyl, ending the Russia-Ukraine war, and even the TikTok deal. With news like this, the market could have even more fuel to go higher. Well, I will break down what it all means in the End Thought segment later, so do watch till the end, alright? Okay, meanwhile, moving on to the market outlook. In the week ahead, we have more than 10 Fed officials speaking to the public, but the most prominent one is none other than the Federal Reserve Chair Jerome Powell. He will be giving his first public remarks on Tuesday, 23rd September, since the Fed's first rate cut in 2025. Just watch out for higher volatility on that day, as traders may take some of his words out of context or use it as a reason to create volatility in the market. The other key event of the week will be the release of PCE index on Friday, 26 September. This index is what the market termed as the Fed's preferred inflation gauge. Basically, this is the inflation measure the Fed prefers to use. If the core PCE comes in as expected, it would give the Fed a clear signal to move forward with more rate cuts in October and December, and obviously the market would love it. Okay, let's now move over to the technical analysis segment. Well, another week, another all-time high. What's there to analyze right now? Anyway, sorry I'm gonna sound like a broken recorder, but as you can see, since SPY broke out of the earlier all-time high set in February this year, it just went higher and higher with multiple new record highs. Like I always have been saying, in this uncharted territory, don't try to short the market, because sellers usually tend to dry up, and you will be surprised how high the market can go before the next meaningful pullback comes. Okay, so when the next pullback comes, which I don't know when, I would be paying attention to that green support trend line. So long as SPY doesn't fall below that line, it means more all-time highs are on the card. Just to add, a bounce off the green trend line like what it did previously is considered bullish. But even if SPY falls below that line, there's still multiple support levels beneath, and we are really nowhere near a bearish market at the moment. That said, in terms of the downside, I personally will watch the 23.6 Fibonacci level and the 50 moving average more closely. These levels are at 642 and 639 respectively. And I will be on my toes a little and perhaps even label it as a meaningful pullback if SPY touches the 50 moving average. Otherwise, any kind of retracement is very minor. It's nowhere near a so-called significant pullback. Moving on, let's check out Apple's chart. Apple is looking decent at the moment, probably driven by early strong demand for their new iPhone. Whether this momentum is sustainable or not, here's what to watch. First up, watch that 249 level. That was the high set in February this year. If Apple can get a solid close above 249, I will not be surprised if the bulls step in further to bring the share price to near all-time high at around 259. And if somehow Apple can go above that record high in the next 2 weeks, then you know the drill. At all-time highs, don't try to short the market because FOMO buyers will step in to drive the price higher and higher. You will see that when I cover Google's chart later on. What makes it even more interesting is that the MACD had a bullish cross last Friday, so I think there is some juice for the upside this week. On the other hand, if I'm wrong and the market makers decide to reverse Apple's trend, watch for two levels below. The first one is that blue support line at around 241. It used to be a resistance level but has now turned into a support. Next, it will be the first Fibonacci level at around 235. If this level breaks, I think there is a very high possibility that Apple will continue to slide further towards 220's range. But at the end of the day, within the 220's range, so long as the 50% Fibonacci level at 223 doesn't break, we are all good. Jumping over to Tesla's chart. Tesla obviously is looking very bullish, but yes, there's a but. It looks a little overextended as the RSI has been trading near the overbought area. However, this doesn't mean that the rally will stop here. To be honest, no one has a crystal ball to tell you where it will move next. Therefore, for the bulls, the ideal scenario is to have a small pullback soon or to consolidate around the current range, which is what it has been doing last week. This will allow the RSI indicator to cool off a little bit before the next leg up. For the bullish thesis, I will keep an eye on two levels. First is the 161.8 Fibonacci extension level at around 426. If Tesla can close above it, that's the very first step for the next leg up. Second, I will watch that blue resistance line closely, which sits at around 438. If you were to ask me, I would say if Tesla breaks above and closes above this level, the leg up would be a fierce and massive one. Believe it or not, we could easily jump 20 points to hit high 450s range, or maybe even test the 200% Fibonacci extension level at 462. Okay, on the flip side, if somehow Tesla or the market turns bearish, Tesla can flush as quickly as how it went up, which means in the blink of an eye, we could be at low 400s before you knew it. At the low 400s range, the level 400 will act as a psychological support. But honestly, if we reach this area, I would think it's almost certain that the gap between 396 and 402 will be filled. If we bounce off the gap area or the big 400 level, then I would say the bullish momentum is still intact. But then, if we don't have a bounce here, then stay cautious. The share price could undo that two big green candles anytime, and it can happen really fast, which means we could be back to 360's range. From the current price of 426 to 360's range, that's a good 60 point drop. Sounds scary? Well, if you're able to ride this 60 point up, you must be prepared to stomach that big movement down, if it happens. Okay, let's now move over to Google. Well, Google is the perfect example of what I always shared. At all-time high and uncharted territory, it will just defy gravity and keep going higher and higher. I mean, as you can see, ever since Google took out that February's high of 206, it did not look back. It was record high after record high. So the question is, when are we going to see a significant pullback? Honestly, I don't know. And I would urge viewers not to believe anyone who said they know. Okay, if the pullback doesn't come this week, that means the share price is going to go higher, and there's nothing too technical to analyze in terms of the upside. You will probably see a new level, which is 260. But then, if the pullback comes, that's when things could get interesting, because the question would then be, how big is the pullback? Will we have the chance to take some form of action such as buying Google shares or selling put option? Well, I think the gap between 242 and 244 will be the best first target. If we bounce off here, then there's nothing to be excited about, because it means the trend is still very bullish and I probably can't take any form of action. But if Google goes below the gap, then I will watch for the first Fibonacci level at around 228. I will deliberate a bit to see if I will sell put option here. The best scenario would be the overall market somehow gets bearish and Google gets sold off with other big tech stocks. Because when that happens, I think there is a chance that Google will be headed towards the huge gap between 211 and 224. That would be a place where there is a high probability for me to sell put options, which is a bullish move. Okay, all in all, so long as Google doesn't fall back into that purple uptrend channel, there is nothing to be worried about. Moving over to Meta. Wow, Meta looks interesting. As you can see on the chart, Meta broke out of that purple downtrend channel last week. So obviously that's bullish, but what's next from here? A few things or possible scenarios to watch. First of all, if Meta decides to be straightforward and test the all-time high at around 796, that's bullish. And if it somehow can close above 796, then as always, it's uncharted territory, so expect Meta to trade above 800 for a while and also expect more record highs. And still on the bullish thesis, if Meta pulls back this week, watch for the first Fibonacci level and the purple channel line as support. These levels are at around 754 and around 750. If Meta can bounce off either level, then the bullish trend is still intact. Alright, let's now cover the bearish thesis. If Meta gets rejected near the all-time high, which is 796, then be very careful of a potential double top pattern, which is bearish. Next, if Meta pulls back to the first Fibonacci level and the purple line like I mentioned earlier and doesn't bounce up, then you might want to watch that 50 moving average at around 746. At the 50 moving average, if somehow Meta breaks below it, it means we are in the downtrend channel, and obviously that's not a good sign. Other than filling that small gap between 740 and 743, I would think there is a high chance that Meta will continue to fall into that big gap between 708 and 721. Okay, just one last interesting observation. It appears to me that there is a bullish inverse head and shoulder pattern, but it's not the textbook kind of version. So anyway, for it to play out, it needs to take out the record high of 796. And if it does, then the share price could really fly. Moving on, we have Microsoft. Well, it's the same old thing for Microsoft, trading and struggling at the 50 moving average level, which is around 511. As long as Microsoft cannot break free from this moving average, it is just moving sideways and there's nothing much to analyze. That said, let's still cover some of the key levels to watch for both the upside and the downside. Last Friday's candlestick looks decent, but one day does not make a trend. So for Microsoft to be caught a little bullish, it needs to minimally close above 523. That's the bare minimum, and we need more than 2 candlesticks above this level. If Microsoft can hold its foot above 523, then naturally 530's range will come into play. But between 530's range and the all-time high at 554 is a good 20 points difference, and we only have one candlestick in that range, which means it will need to take a big positive catalyst for Microsoft to even go near 554. If the move doesn't happen, it wouldn't be surprising. In fact, I would be more surprised if it does so without major news. That said, if Microsoft does break into the 550s range, oh boy, we are looking at new record highs again. As for the bearish thesis, watch that 50% Fibonacci level closely, which sits at 489. If that breaks, then I would say Microsoft's short-term trend is leaning bearish and we could potentially see more decline, probably into the 470s range. Okay, moving over to Nvidia. Among the various stocks that I covered, Nvidia's chart looks the most interesting for this week. Why so? Well, on the surface, it does look like it's on this mini downtrend with a series of lower highs, but there are some positivities and potential bullish signals. Let's break them down. First up, we have 2 nice green candles above the 50 moving average. That's called reclaiming the moving average. If we can have another green candlestick above it, then the bullish momentum is even stronger. Next up, check out the MACD. It looks flat, but when I zoom all the way in, it actually had a bullish crossover last Friday. But like I said, it looks flat, which means the signal is not strong yet. We need a convincing crossover to have a bullish confirmation. Let's see if it happens this coming week. And then, just like Meta, it seems like we have a mini bullish inverse head and shoulder pattern on the chart. But again, it doesn't look like the textbook version or setup. And for this to play out, it needs to break above the all-time high at around 184. And when it does, and when you combine the theory of uncharted territory with the inverse head and shoulder pattern, the stock could fly really high. So those are the reasons why I think the chart looks interesting, because on paper it looks a little bearish, but there seem to be bullish signals hidden underneath but yet to be confirmed. So pay very special attention to what I shared earlier to see if any of those signals play out this coming week. On the other hand, sorry as always, if you appreciate my free content and found it useful, you might want to consider supporting this channel through any of the following ways. I would be really grateful. Feel free to pause the video to look through the details. Alright, in terms of the bearish thesis, all I can say is to watch that 38.2 Fibonacci level as your first signal of bearish momentum continuing. That level, which sits at 168, has acted as a support level on a few occasions already, so that makes it a potential bounce point in the weeks ahead. If Nvidia doesn't bounce off here, then we should be on alert a little. The next level of support is the pivotal 50% Fibonacci level at around 163. If that breaks, I think the odds of us seeing Nvidia back below 155 is pretty high. Okay, let's move on to the next segment, options trade. I only have one trade to update this week, and that is this new cash secure put on Tesla that was sold last Thursday, 18 September. The strike price is $2.95 and the contract will expire on 31st October. Alright, I wanna be honest, I don't want to lie about what technical setups and all. For this trade, there's really nothing too technical about it. I was merely selling it to earn my monthly options income. In fact, I think this is a risky trade because Tesla is quite overbought and there's a risk of a pullback soon. Therefore, please don't follow me blindly. Okay, but that said, there were still a few things that I considered before entering this bullish trade. First, I saw the implied volatility or IV was quite high at 70%, which makes the options contract expensive, and that's good for option sellers like me. In case you're not aware, generally speaking, IV of 70% and more is considered high. Another reason is because the major market overhang, which was the FOMC meeting, is now behind us. Unless some unexpected event occurs, there don't seem to be any known catalysts that could tank the market or Tesla share price over the next 1 to 2 weeks. Finally, as mentioned earlier, technically speaking, Tesla faces some risk of pulling back with the RSI near overbought zone, which was why I chose a relatively low strike price of $2.95. When I sold the contract, Tesla was at around $4.29, so for it to breach my strike price, it has to drop around 31%. Not saying it can't happen, but the odds are not that high. Moving over to the end thought segment. Okay, so far in September, the three main US indexes are all performing well. This is unusual because September has historically been a difficult month for the US stock market. I have shared in my previous videos that whether you are looking at the past 20, 50 or 100 years of data, September typically posts the lowest average returns. So what does this tell us? I think it's a reminder to us that nothing in the market is guaranteed or 100%. The market can always defy odds and patterns. That was why I have been selling put options this month, which is a bullish strategy. My thinking is that if the usual September weakness shows up, it's fine because my contracts will likely recover by October. But if the market follows the seasonal bearish trend, I will benefit even more as those put options will be in the green even before October, which is exactly what's happening right now. Anyway, here's my take on the current market and situation. The recent Fed rate cut came amid a slight slowdown in the US economy and labor market, but not a slump or near recession environment. This is positive because the Fed doesn't seem too far behind the curve, at least for now, though this is debatable. Personally, I believe the market could see more upside in the next few months because historically, a Fed easing cycle in a non-recessionary environment has supported stocks. Again, I would like to remind you that nothing is guaranteed, okay? But beyond historical trend, this bull market's resilience is underpinned by strong fundamentals, which includes a tech-led investment cycle in AI, robotics, quantum computing, autonomous tasks, and more. In addition, corporate growth and earnings remain solid. The business environment under Trump administration is friendly, and most importantly, we have a relatively accommodative Federal Reserve. That said, I always remind viewers to stay cautiously optimistic. I mean, there are reasons to be mindful. For instance, the S&P 500 is trading above average forward earnings and the volatility is suppressed. Therefore, a period of consolidation or choppiness is expected, and that is completely healthy. The only unknown is the timing. We don't know when it's gonna happen. But in the short term, the momentum is bullish, that's undeniable, which was why I have been trading the upside. But at the same time, I am keeping my cash ready to step up shares on a healthy pullback. Last of all, just a quick thought, as we enter the final week of September, I'm curious to see if exhaustion or consolidation will set in, to basically echo the historical bearish September trend. What do you think? Will we see a pullback this coming week? Let me know in the comments section below. And before you go, don't forget to like and subscribe if you haven't already. Thank you, and I will see you in the next video.